we have a guest joining us today who's got a very good world view. I'm talking about Ajit Dayal, who's joining us from New York now. Ajit, thank you so much for your time. First of all, I'd like to talk about the latest trigger, which did impact market sentiment to some extent. The rally in US yields, the rally in DXY, and then the war crowds also coming in over the weekend. They eased a bit. How much risk do you see, these kind of issues have for emerging markets, particularly India?
So when the Fed started announcing in 2023 that there was an interest rate hike cycle, the markets paused, not sure what that meant. And then, of course, the strong economy kept the markets moving with an assumption that at some point in time, as inflation tapers around the world, central banks will cut interest rates and reduce them to certain levels that a generation of new investors from 2008 have been used to, which is low interest rate. And what's really happened is that, as you correctly pointed out, while sales in America and the GDP has been strong, there's now the concern in the US particularly that will they actually start increasing interest rates? Interest rates are extremely important for the entire world allocation, because if a pension fund, if a foundation can earn 5%, 5.5% in dollar terms from a fixed deposit in their local bank account, they don't have to put a lot of money to the external world, to the like India, to stock markets like India, or PE India, or real estate India, or infrastructure or venture capital. Their target rates of return are roughly between 6.5% to 7% at max. And if you can get a chunk of money at 5.5%, you'll only invest 10 or 20% of your total allocation to get a high rate of return in foreign markets. So that US interest rate is kind of the guard to determine what happens in allocations around the world globally. That's very important to recognize. And as you correctly again said, as interest rates now are likely to increase, what we worry about as people sitting in India should be, will there be enough allocation to India in a higher than longer interest rate environment from the US? The European cycle is different. The European cycle is inflation is being tamed, and therefore interest rates are likely to head down. So you may have this divergence where in Western Europe, you'll find interest rates being cut, may not be at a fast pace, but the signal and the action is on a downward trend. In the US, it's uncertain. European capital for India is also important, and European capital is increasingly trying to find alternatives to be in other nations besides China. So there's this of two continents, if you will. One side of the Atlantic, you have this fear from our side that interest rates will remain higher, and therefore allocations to India may be a bit slower. And on the other side of the Atlantic, closer to India, you've got the European era, where in the European area, you've got chances of lower interest rates, more interest in India, and therefore more allocation to India. That's the way we should look at it in general.
Right. Ajit, on the one hand, there are these external issues or factors which are keeping markets on tenterhooks and traders and investors. But on the other hand, there are also developments such as the recent one, IMF raising the forecast, growth forecast once again for India, and good commentary coming in. Tell us about how does the macro look on a more structural basis as India is concerned?
Yeah. So the Indian market, the Indian investor and the international investor investing in India should really focus not so much on GDP, but there are certain factors at the macro level which are positive for India. So if you look at CMI's employment data, it's looking a little better, but there still is in some sense K-shaped recovery in the world and in India. You will find, as one of my colleagues was flying in from Bombay to New York, and he was saying that the flights in business and first full, and the flights in economy were not so full. So you're finding that sort of K-shaped recovery where the rich have gotten richer, the poor are getting poorer. You see that in the FMCG sales, not much volume sales coming out of rural India, but there's massive consumption happening within urban India. So you're seeing that mix around And therefore, when you look at GDP numbers, we tend not, I wouldn't say ignore is the wrong word, because GDP has a lot of has a lot of constituents to it. So therefore, we would not rely too much on GDP. It's a headline number. We'd like to know where the demand is coming from, which sectors are likely to benefit, and most importantly, as we've seen in the recent ICICI Bank and ISEC case, what is the governance or the level of governance, as in the case of ICICI Bank, that will impact my returns as a minority shareholder. We have this strange situation where ISEC, the securities company of ICICI Bank, listed entity so far, has had a 66% growth in profit. Any company with a 66% growth in profit would have a surge in share prices. Yet the ISEC board members and ICICI, sort of board members have stolen ISEC shares from the minority shareholders, and the share price will not surge to a market level. It's trading at a P/E ratio of 13 times compared to 33 times and 25 times for the indices. So, this is what upsets any international investor and a local investor. It's not the uncertainty of US Fed rates. It's not the uncertainty of what's going to happen when 300 drones cross, different continents and different borders. It's not macro politics. It's not macro GDP in India. It's how I am respected and treated as a minority shareholder. That is the straw that can break the camel's back, misgovernance. And I really want to focus a lot more on that in future discussions that we have. The macro story is nice, but if you don't treat me well as an investor, I don't know what the macro story is for India, right?
What are your thoughts on the valuations of the market right now, especially the broader market? Because there was a very decent correction played out in mid-cap and small-cap ever since commentary on broader market valuations came in from the regulator. Then the entire stress test from the AMFI side also was a bit worrying for the market. Now the small-cap, mid-caps are coming to terms. How do you see that factor playing out?
So I think for the small-cap space, I think the regulator was and is in a tough bind. You've had, if you look at 2008, small cap funds were 2% of total equity AUM, 2008 when Lehman went bust. And in the year 2008, small cap funds, international and domestic, the few that were there, declined by 60 to 80% from January 1, 2008 till December 31st, 2008. Fast forward to this era that we are in. Small cap funds are roughly 8% of total AUM in equity. So you've gone from 2% to 8% of a larger share of equity. On top of that, and I don't have data on this, but I know the regulator definitely will have data on this, the people who've entered the market post-COVID, 2020 onwards, trading on their, on their apps and on their laptops from home, my gut and my guess that they are a younger generation by age and also taking more risks because they are mostly novice to the world of investing. So my gut is that their allocation to small cap funds is not 8% as is for the universe of all investors of total equity. It's probably more likely 40, 50, 60%. And God forbid, if there are incidents internationally or locally, which cause a 2008 kind of rate of return, i.e. a 60%, 80% fall in small cap prices, what could happen is have a lot of discontent. So in 2008, there may have been 1 million people owning small cap funds. Today, that number is probably 10 million. So you'll have a lot of 10 million people who are angry with SEBI. And it's not the fault of SEBI. Like SEBI correctly said, the job of the regulator is to frame the market, not to tell you whether shares are expensive or not. So SEBI has done the smartest thing possible. They have sent a torpedo, not towards the ship, but across the bow of the ship. And they sent a warning for those who care to listen and for those who wish to listen. That listen, be careful. Valuations are a little stretched and illiquidity is a massive concern in small cap funds. We have done our own analysis. Actually, Personal FN had done it and we've looked at the data. When Personal FN did this analysis on small cap funds, found, and I'll give a name here, Nippon, one of the top 5. We did of all all the top 5 funds. Nippon is the largest small cap fund, manage roughly 45,000 crores. One of their top 10 holdings would take 3,000 days to exit, 3,000 days of trading, which translates to roughly 15 years of trading to exit one stock in their top 10. If you look at it for all of them, HDFC, Kotak, SBI, I forget the fifth one, but you look at all of these 5, they all have got a lot of illiquid stocks. What AMFI has done, in wisdom or lack of it, is that they have told the fund industry. SEBI has not set the guidelines to determine what is liquidity, illiquidity. They left it to AMFI. AMFI, of course, is a protector and is an association of manufacturer of mutual funds. Quantum AMC is also part of AMFI by law. We have to be part in spirit. And when we do our own stress test, we use different criteria. What AMFI has used is take your 20% portfolio, which is most illiquid, and don't count that. Just pretend it doesn't exist. And then tell me what your liquidity is. Now just think about the sense of this, right? When there's a redemption, therefore the small cap fund, if and when there's a redemption, will sell most liquid shares to those who are leaving. And the people who are staying in the fund, imagine that they'll be holding more and more illiquid shares in the fund. So you're basically building up a time bomb where you're forcing retail investors, those who remain, those who are committed, to hold more illiquid shares. That is the illogical sort of calculation that's come out of AMFI. And therefore, there's been that bounce up again in small cap funds, in small cap valuations, in small cap prices, because everyone now says, AMFI has done its great calculation and there's calm in the market. Not at all. Small cap funds are a time bomb that's going to blow up. I have no idea what the catalyst is. I have no idea what the time period is, but it's massively dangerous. And for those who remember history, and very, very few do, please look at the small cap fund graphs from January 1, 2008 till December 31st, 2008. And you will realize that we don't know the timing and don't know the catalyst. But if things go bad, small cap funds are going to be the worst place to have a big chunk of your allocation. Should you be in small cap funds? Of course. Should you have 40, 50, 60% in your small cap funds? Probably not. Should you have 5, 10% in small cap funds? Probably less. Yes, and you should have small cap funds that are declaring liquidity on a proper basis. Not this 20% illiquid stocks are exempt. That's a bit crazy in my view.
All right. Before you go, Ajit, a quick view on, the election season is around the corner and everybody is talking about the next generation reforms the government may take. Parts of the government themselves indicating at the next generation reforms which lie ahead. Any thoughts there?
So, I wrote an article in 1990 February, so 34 years ago, about how India will reform or the loosen the reins on the bull market. That was the title of the article for the Asian Wall Street Journal way back when. And since 1990, we've seen a bunch of reforms. 1991, the big reforms, and then you've had a whole bunch of reforms after that. This government over the last decade has continued with that pace of moving India forward, and it has the massive advantage of what happened under UPA 2, which is Aadhaar technology. We've got smartphones, we've got lower telecom cost. So a lot of the digital-based reforms, banking, financial services, reporting reforms was something that started 11, 12 years ago. And this government, to its full credit, has sort of carried on and maximized the use of. I think that the hard reforms, which is the hard infrastructure reforms, have also been accelerated by this government. It started with Vajpayee. He had the golden quadrilateral triangle on road infrastructure, hard infrastructure. It did carry on during the UPA 1 and 2, but they got embroiled in all sort of discussions on corruption and coal mining and coal ore and iron ore, all that stuff. So it kind of got derailed for the last few years of UPA 2. Whereas in this government, there's been no discussion in the press on corruption, and you just moved ahead with the sort of hard reforms, which is important. So you've got the soft digital reforms, which build the platforms, and you've got the hard infrastructure reforms that are allowing the truck and the roadways and the electricity to move through and help us all grow. So India continues to be, in my opinion, for the last 4 decades, a phenomenal wicket. And India can only be its worst enemy. And governance, CEOs can be India's sole and worst enemy. And which is again why I spoke about ICICI Bank and ICICI, because what will ultimately determine whether an individual investor or a foreign institutional investor in India makes money or not is not going to be the big reform. It's going to be, how do you treat me as a minority shareholder? That at the end of the day, if you were an investor in Alibaba, in Jack Ma's company, and the Chinese government makes CEOs kind of disappear, that's misgovernance. Here you have private sector managements like ICICI Bank evaporating my profits that I could make from a stock that I picked, because they choose, through the help of proxy agencies, board members, and their hundreds and thousands of their people calling up ISEC shareholders, telling them how to vote. Apparently, that sort of misgovernance is the one that people will be most upset about. So the macro story for India, irrespective of which government comes to power, in our opinion, since 1980, over the last 11 governments, remains constant. 6.5% rate of growth of GDP on an annualized basis long term. You may have spurts, as you had under UPA 2, of 7%, 7.5%. You may have spurts like you had in India at COVID, when there's a slump in GDP. But India looks fantastic. India is a place to invest. All we need to ensure is that governance remains, and misgovernance at the corporate level is eliminated. That's what we need to worry about now.
All right. Thanks for joining us on the show today, Ajit. Have a good trip there in the US, which you are visiting right now.